In this video, we will talk about Fortinet. We have some updates, we have some new analysis that are very bullish to the stock. We will cover a lot of ground on this video. It will be a very complete, action-packed video. We'll talk about the latest updates, the latest earnings report, the latest Fireside chat. We'll talk about some competitors that released earnings, including CrowdStrike. We'll talk about the philosophy and the valuation, and you will have my thesis why I'm still bullish on Fortinet, and actually I want to buy more. So I'm extremely bullish on the company, on the stock, and I want to increase my exposure, and I currently buy Fortinet. So if you want to follow me on this trade, on this investment, this video will help you a lot. And in case you are doing some research, you will learn a lot of things in this video. In case this is your first video from this channel, welcome. My name is Christophe Nour. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. Okay, doing stock picking, no leverage, no options, no crypto, just pure stock picking the Warren Buffett way. We want to invest in quality companies that are outperforming the market and have generated 25% in the market. So this is not the first time I bought Fortinet. I first bought Fortinet in 2020 here, and I sold in 2021, 2022 at the absolute top. It was a quick triple in 2 years. This is the reason why I have generated more than 20% per year. Okay. I have a lot of tabs for you, a lot of value. Take a cup of coffee, take a cup of tea. Please relax, enjoy the show, and I want to talk about specific news. But first, let me do a quick 1 minute overview of the business. Fortinet is a cybersecurity company that is having a market cap of $60 billion. Margins are sky high. It is a company that was known for the hardware, but is shifting progressively to software with better margins. One of the key leaders, one of the biggest companies in this cybersecurity industry. Revenue is up and to the right. Net income is up and to the right. The company has no debt, that is filled with cash. The company has a free cash flow that is up and to the right. And they are doing buybacks with a nice return on investment. And since the latest earnings report, the company dropped. The stock dropped, okay? 20%, and I bought here. This was for the introduction. The company, as I told you, is filled with cash, and they use this cash to do buybacks. If you look at the history of the company, this is not the first time they do buybacks. This is a chart I want to show you. I will show you a couple of charts on this video. The cash from operating activities, that is in red, and the buybacks that are in blue. Okay? You see that a couple of times they used their cash flows to do some buybacks. Every time the stock dropped, every time the stock was cheap, the company says, okay, we are going to increase the buyback program. We want to repurchase our shares because we think our shares are cheap, so let's invest in ourselves. What is great is the company doesn't have debt. They are filled with cash, so they can be flexible with the buybacks, okay? They can, look at this. They use this cash a little bit in the last quarter. They reduce the cash pile to do a little bit of buybacks. 0.5% of their shares were bought back. And this is only the beginning. So the philosophy of the company is to do buybacks. This is the only player in the cybersecurity industry that is doing this kind of buybacks. The only player. I am doing a deep dive on all the key players. All the key players are focused on innovation, growth, CrowdStrike, Palo Alto Networks, Zscaler, etc. This is the only company that is growing, that is doing some buybacks. Okay? The other ones are focused on M&A, acquisitions, etc. You have another company called Checkpoint Software that is doing buybacks in the cybersecurity industry, but it is not growing. So, different kind. Either buyback and not growing, or now Fortinet, buyback and growing. So I prefer Fortinet for this reason. Okay, so this was for the proof of the company has been doing buybacks in the past. If you look at the investor presentation for May 2025, so every year you have an annual presentation to shareholders, to all the analysts, you see that at the beginning of the investor slides, you have one slide, the first slide for financials. the margins, 20 years of strong growth. Fortinet has been GAAP profitable and free cash flow positive every year since its IPO in 2009. The company is focused on efficiency, profitability, free cash flow. Second slide, they talk about buybacks. This is maybe the only company, maybe one or two companies in this industry that are that have such a focus on buybacks. Second slide out of the investor day. Look at this. 35% increase in earnings per share due to share repurchases. They have returned $6 billion to shareholders via share repurchases. Okay, they have repurchased this. This has caused the earnings per share to grow. And look at all the years, boom, boom, boom. As they generate more cash flows, they do more buybacks. And they did some buybacks year to date in 2025. Actually, the company did some buybacks, but in a smart way. And this is what I'm also teaching my students. Not all buybacks are great. You can have smart buybacks and you can have stupid buybacks. So you want a company to make buybacks when the stocks are cheap and dropping and undervalued. And when the stocks are expensive, overvalued, no, you want to stop the buybacks. You even want to dilute your shareholders, like make an M&A deal using your expensive shares. But now we are at the beginning of the year, and they did some buybacks in the second quarter, so between April and June. And what happened between April and June? If you look at the year-to-date performance, you see that we had the April market drawdown in 2025. I don't know when you're watching this video. Maybe it will be in a few months, in a few years. But we had a drawdown in the market and the stock fell from $100 to $80. The company seized this opportunity to repurchase shares. Like the average price was $87. I calculated it. So the company did not do any buybacks. We are expensive. Boom, you have a big drop, massive buyback. And then the company rebounded and they stopped the buyback program. This is exactly what you want. This is a very smart way to allocate capital. If you want another company that does it this way, it's Brookfield, ticker symbol BN. They just wait. And when the stock drops, massive buybacks in a few days, a couple of hundreds of millions of dollars. And then when the stock rebounds, you stop. Guess what happened when the company reported earnings recently and the stock dropped 25%? Okay, very well. Guess what happened? A few days ago, we had a press release for the company saying what? Fortinet expands share buyback program by $1 billion. Buy now or hold. Well, that's an article written about this one. As I told you in this slide from the investor presentation that was released in May, so before the drop, the company had $1.6 billion buyback authorization remaining. So when the stock dropped 20% because of the report, they had $1.6 billion. Okay, they added $1 billion more. Okay, so let me draw. Maybe that would be good. Before the report, how can I draw this so you understand? 1.6 billion. Okay, so that was before the report. And then the stock price dropped. This is the stock price dropping. And after the stock dropped, we have this, 1 billion. What does it say? If they did not do any buybacks. Oh, actually, I should have done this better. Let me do this instead. Okay. Very well. This is this candle worth $1.6 billion. They are adding $1 billion more. So the big candle should be up to $2.6 billion. Okay? Fair enough. If you read this press article, you will learn that the management did something. If you read this article, you say they extended this share buyback program and with approximately $1.2 billion remaining under the program, including recent increases, this represents a substantial capital allocation commitment. please read this twice. The rest of the article will give you no value. Only this line is important. They increased by $1 billion up to $2.6 billion. And now what is remaining is $1.2 billion. So actually what is remaining is this small candle, $1.2 billion. What it means is the stock dropped. The stock dropped 25% because of the report. And they increased the buyback program to 2.6. And they already repurchased this difference. They already consumed the buyback program. And the difference is what? $1.4 billion. So this is exactly what we've seen before, like in April. The stock drops, the company does some big buybacks. Now, with the report, the stock drops, the company does big buybacks. What did we see in the slides? We said that the company repurchased $400 million at $80. And what you can see is, since the stock dropped, the company didn't repurchase as much, like $400 million. They repurchased $1 billion more, $1.4 billion. Okay, fair enough. If you want to see if this is a big buyback or not, you can check what has been the history of the buybacks over time. Let's check the cash flow statement, literally. Let's check. There is a small bug, so let me do this very well. Now you can see on a quarterly basis. Because now we know they repurchased shares, they already used. What can we say? This is the line in red for the buyback program. I would say you have a small bug on fiscal AI. The $400 million in buyback that was happening in April is not shown on this line. Strangely enough, so I have to put this line cash flow from financing activities. It is roughly the same. The red lines are the buyback on a quarterly basis. And you have one positive line because they had a little bit of debt. So please remove this line that is positive. Remove this candle. Don't think of this candle. All the negative figures that you see here in red are the quarterly buyback figures the company had. So far, the biggest buyback quarter was COVID. During March 2020, they repurchased $900 million of their own shares. That's their biggest buyback ever on a quarterly basis. Last quarter, they did $400 million. And what did we just say? They already did $1.4 billion. So, if I'm correct, right now, we are in the biggest buyback ever on a quarterly basis. This is the first time in Fortinet's history that we have this level of buyback.
By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video.
So in the next quarter, in Q3 2025, you will see this cash pile declining. They will have used $1 billion, a little bit more than this in buyback, and you will see a big line for buyback. This is the first time in history we have this kind of buyback level. What does it tell you? It tells you that management has confidence in the business. It tells you that the management thinks the business is cheap. And this is great for us shareholders. I'm a shareholder of Fortinet right now. So I'm biased, obviously, but I try to be objective here. Objectively, it's the biggest buyback ever for this company. So we have this article remaining. Look at this, with approximately $1.2 billion remaining, including the recent increase. So my formula should be correct. We'll see for the Q3, but I think they have consumed minimum $1.4 billion, and the quarter has not ended. What if they continue to do buybacks? What if they announce a new buyback program and they repurchase $2 billion of shares? Anything is possible. I will not hope for the moon here. $1.4 billion is great. We'll see how it goes. So now you may ask, is it the best use of capital for Fortinet? Well, the stock is cheap, right? So is it the best use of capital? Can you do better? If you look at the ratio, the EV to free cash flow, the company is rather cheap compared to last year. Before this report, before the stock crashed 25%, it had the EV to free cash flow, so that's a valuation metric, of 38. And it dropped to 26, and I bought at 26, 27, something like this. What has been the average of this valuation metric for the past 10 years? The average has been 26 here, and the median 23. So we are roughly back to average. Okay? Fair enough. You can also create custom metrics, look at the operating cash flow because of the capex involvement, etc. Well, you can play one with the metrics, but the results are the same. We were expensive, and now we are fairly priced. Maybe a little cheap or fairly valued. I am not building a full position now. I hope the stock price continues to drop so I can double my position. I think the stock is fairly valued right now. We have an exemplary business model in a thriving industry. The cybersecurity industry is expected to grow 12% per year. All the metrics are in the green. Wonderful, no debt, a lot of cash, smart capital allocation, founder-led, high ROIC, return on invested capital, buybacks at a fair multiple, fairly valued. I'm loving it. Okay, next point. I have another couple of points for you that will add some value. Okay. So that was for the buyback program. Just so you know, right now the company is enjoying the biggest buyback ever. And I've seen 0 video talking about this on YouTube. So please leave a like if you like this kind of updates. Another update we had is recently, after the 25% crash in the stock price, the company had a fireside chat in August after the stock price dropped 25%, and we were given a couple of updates. So it's a private chat, and the management was talking to I don't know which bank. Is it Citi, JP Morgan, Goldman Sachs? I always forget. We need to run this event. I have a doubt. Anyway, and we have a private conversation that was recorded and it is out to the public. If you want to access this chat, please use my affiliate link to sign up to Fiscal AI. You click on Investor Relations, and this is the fireside chat here. They told you that Wall Street was too bullish on the company. So this is the reason why the stock dropped. But the company is still growing roughly 15% per year. So business is healthy, as usual, no warning sign at all. And we are very positive in our estimates. We are continuing to grow 15% growth. In the cybersecurity industry right now, you see a lot of acquisitions, M&A deals. And the analysts from the bank is asking, Microsoft, are you thinking about doing a large M&A deal? Is that part of you think that would fit your DNA? Do you feel like it's necessary to make acquisitions like all the big players? You look at Palo Alto Networks, it's another cybersecurity industry company. They have made more than 10 acquisitions. So it's part of their DNA, part of the CEO that joined Aurora in 2018, by the way. And you look at CrowdStrike, another cybersecurity company. They recently announced a new acquisition. But Fortinet, no. No acquisition for Fortinet. They focus on buybacks. They use the cash not to do for acquisitions, but to do buybacks. Why so? You will see. They answer this question. Why don't you do acquisitions? I think we need to see why they do the acquisition, right? So the reason is that the network secures cybersecurity. We need to innovate a lot. That's part of the infrastructure. So I do believe the best way to develop all this new function, the infrastructure, that's the CEO talking, Kenzie. The best way to develop all of this is internal innovation. What it means is they don't want to do M&A deals. They want to continue to focus on internal innovation. So that's actually a lot of bigger company. When they got bigger, it's a lot difficult to keep up with this internal innovation. The more dependent to catch up, etc. Also, what they mentioned on, I will not read anything. You guys have to listen to this interview. They mention all the risks associated with acquisitions, the integration risks, the synergies that were supposed to be here, and you fail in the synergies because that's different cultures. When you acquire a company, you expect the best of the two worlds, of the both worlds, but sometimes the acquisitions are failures. No synergies, you have integration risks, a bloated company, many costs, and Fortinet doesn't like this. The management team wants efficiency, wants to be lean, wants to do smart capital allocation decisions. So this is too much risk to have this M&A integration risk. So they don't like this. So are not even integrate. That's where for us the number one priority is to keep up with the internal innovation, which we are working better to integrate with other solutions from day one to integrate together design. So that's always a company priority. Even we'll get bigger now. We want to keep up with innovation. So in the future, don't expect acquisitions like other companies. Fortinet is different from the rest of cybersecurity companies that are doing acquisitions every year. Fortinet will not make acquisitions. The challenge is the integration. Yeah, this is what I said. The challenge is the integration part. So we want to plan like 95%, 98% of the integration to be sure. So it's a risk. This is a pretty low risk to innovate internally. Blah blah blah. This is our philosophy, internally. Blah 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 blah. Okay, fair enough. So this was the first highlight we learned in this Fireside chat. When everybody is doing acquisitions, Fortinet is not doing acquisitions. First key highlight that is new update that was not seen on the report. What did you say? Second highlight, key innovation. Oh yeah, that's the okay, very well. Second highlight is the 12% growth. I told you a couple of minutes ago that the cybersecurity industry is expected to grow 12% per year. So the cybersecurity industry is a new industry. It's only 20 years old. Like before the internet, we didn't have this. And now you have this new wave, digital world, AI threats, AI cyber attacks. So you need AI cyber defense. So the budget, the cybersecurity budget will massively increase in the future. This is what I think. We'll see how it goes, but I think this industry is only in the early innings and they will thrive in the future. As the world gets more digital, we will need more cyber defense. And these companies will be here to give you anything you need. They talk about the growth rate. The analyst here is asking, your 25 number, you estimated guidance for the full year is 13%. So maybe why did you choose 13%? How can you estimate your future growth? So why did you say your guidance was 13% growth rate? And Ken Z, the CEO of Fortinet, is telling us. So I look on this one. The reason we gave above 12%, like 13%, is that if the overall market for the cybersecurity industry is growing 12%, we do believe we're gaining market share. We grow above the market growth rate. So the 12% has come from the Gartner, so the analysis part, say the next 4 or 5 years. The secure networking will grow probably at 8%. And then the unified SaaS, maybe 18%. And then the AI-driven secure are probably like 10%. What he is telling us, investors, is they are not sure about their future growth rate, but they think they will do better than overall market growth rate. So they will do better than 12%. In other words, their guidance of putting 13% is on the low side. Fortinet thinks they will grow at minimum 13%. But it can be 14%. It can be 15%. If you look at the track record of Fortinet, if you look at the past 5 years, 10 years, this is not the first time they have a conservative guidance. They announce 10% growth rate and they do 15. They announce 12, they do 18. So the guidance right now is very conservative for Fortinet. They just picked the average growth rate for the cybersecurity industry of 12% and they say, yeah, we'll do more. So let's put 13. So it's 13% minimum. That is not priced in the market right now. If you look at the estimate, I mean, we can click on the estimates from Wall Street. I click on estimates. I look at the revenue growth rate. This is not priced in. Wall Street is not expecting a better growth than this. They expect the growth rate should be 14, 12, and 11. So they expect even less than the growth rate of the industry. Just so you know, guys, I will show you the revenue growth rate for this company. The revenue growth rate for this company was 30%, and then 15%, 13%, 17, 20, 20, 20, 28, 30, and now we are back to 15%. The company was almost never having an 11% growth rate. So Wall Street thinks the company will decelerate, and I take the other side of the coin, meaning I think the cybersecurity will accelerate in the future because of all the digital world is happening, AI involvements, AI attacks, everything is moving in the right direction. So to that extent, I think Wall Street is wrong. We'll see who is right here, if Wall Street is right, if I'm right, we'll see. But I will take the other side of the coin. I will take the other view, and I will be very bullish on Fortinet. We'll see. Okay, so we grow much faster than the market. Actually, we grow like 30%. So that's all the three combined, blah, blah, blah. That's the market share. We assume the market will grow 12%. We are very confident we will grow above the market in the next 3 to 5 years, above 12%. This is not priced in from Wall Street. I read all the equity research articles, all the reports from Wall Street, all the Morningstar articles. People are conservative when it comes to Fortinet. They said that they only highlight the risks of the refresh cycle that is halfway through. They see the negative. We'll see who is right, actually. I'm not 100% sure, and I will never be. But in terms of odds, I'm quite confident. We'll see who is right. I'm very curious to see who is right for the next 5 years. But I think, based on my analysis of Fortinet, I've been following the stock for so many years. I think they will grow much more than 12%. They can do 15 or 20% per year. And if they grow 15 or 20% per year, you can guesstimate the PE ratio will go much higher. The market will see it's a higher quality business. And if you think Fortinet can grow at 20% per year, the company is cheap right now. Okay? So that was for this one. Now, let's change gears a little bit and let's talk about CrowdStrike. CrowdStrike, another cybersecurity company that is great, innovative, and that is more focused on the software part. Okay? They reported earnings a few days ago as I'm recording this video, and they announced an acquisition, they announced a growth rate, and the stock did not move much, like a -5, +5%. They say they expect to grow 20% per year, but the cloud segment will grow 40% per year. Anyway, this is not the goal of this video. The goal of this video is to give you some highlights in this industry. CrowdStrike is a great company. It's a big company, $100 billion of market cap compared to Fortinet at 60 billion. Okay, the revenue is growing, but the company is not profitable. Total revenue, can I show you? Look at the net income over time. The company has almost never been profitable. So this is what I say. The philosophy of Fortinet is very different from the rest of the industry, in the cybersecurity industry. Most of the players want to not be profitable, but focus on innovation, R&D, innovation, key technology. So they reinvest everything on purpose, right? If they wanted to be profitable, they could be profitable. But they reinvest everything, so on a GAAP basis, on an official basis, they are not profitable. Look at this. It is always negative. And now we are back to unprofitable territory. So literally burning money. And the free cash flow is only up because of the large SBC. We'll talk about this later. Every year they are diluting the shareholders. So they issue more shares. That's the reverse of buybacks. Compare this, dilution every year. Compare this with Fortinet. That is reducing the number of shares, doing buybacks every year. The philosophy, the mindset, the vision of these two companies are very different. Okay? And if you look at the report for CrowdStrike, it's great. And I want to mention the growth rate. In the past, Fortinet was growing 80% per year. This is the revenue growth rate. You see this chart. And after this, they were growing 60% per year, 50% per year. And now we are at 20% per year. Okay? This is the total revenue growth rate for Fortinet. Yeah, I want to compare the revenue growth rate of CrowdStrike and Fortinet. So Fortinet is growing 15% per year. CrowdStrike announced a growth rate of 20% per year. Let me show you this now. I'm telling you, you will have a lot of value in this video. A lot of things happening at the same time. It will give you a lot of value. It's an action-packed video. Leave a like to this video. Please comment. Say if you want more videos like this. Plenty of content that I would love to see if I was a shareholder for any of these companies. Okay, now you have plenty of charts, colorful charts. This is not a chart for children. Don't mind all the colors. This is the revenue growth rate for all these companies. Fortinet, Checkpoint Software Technologies, Zscaler, CrowdStrike, and Palo Alto Networks. These are cybersecurity companies. And I want to compare the revenue growth rate for all of them. Because as we said previously, you have a shift between Fortinet, focus on efficiency, but only 15% growth, and the rest focus on innovation, not profitable, and growing massively the revenue. Okay? You can see the thesis based on this one chart. On the green line, you see CrowdStrike revenue growth. In the past, when they IPO'd in 2018, it was a company that was growing the revenue 80% per year, 70% per year. And now the growth rate decelerated with size. And now they are growing 20% per year. And they have a guidance for the rest of the year, for next year, of 20% per year. Okay, next one. Zscaler, another cybersecurity company, growing 40, 50% per year, 30, 50, 60% per year. And now they are growing only 20% per year. What I want to say is, you have two camps, Fortinet and the rest. The rest was not profitable and deserved a more expensive valuation because they were growing 60% per year. But now seems like everything is, how would you say, this size. Everything is converging towards the 20% growth rate. If everything is converging and the growth rates look the same now, is the premium deserved? Are the premium valuations deserved for CrowdStrike, Zscaler? Maybe you will say yes because of valuation, but in terms of revenue growth rate, not that much. You have Palo Alto Networks that is following CrowdStrike, Fortinet. Palo Alto Networks is very similar to Fortinet, better quality, I would say. But struggling to be profitable and not the same capital allocation. Anyway, and you have a Checkpoint that is not growing. Checkpoint is a cybersecurity industry growing 5% per year, so definitely not the same kind of category. This is not a quality company, I would say. It's a buyback machine that is not growing. If I look at the things since 2020, look at everything that is converging, the growth rate for revenue converging towards 20% per year. Now, seems like everybody is having the same growth rate. And Fortinet is in the middle of the pack, roughly 15% per year, like everybody else. And Fortinet is maybe the cheapest out of this pack that is growing 20% per year. Very interesting. Very interesting. Like all the revenue growth is converging. To that extent, I think if CrowdStrike and Zscaler continue to decelerate, they are getting more expensive by the day. CrowdStrike is known for growing a lot. If they don't grow a lot, they will not deserve a valuation that is elevated. It is not profitable. Most of the cash flows are because of the SBC. Anyway, let me show you what I mean by all the cash flows are driven by SBC. We are getting into an advanced territory now. Congrats for following so far. If you look at the free cash flow for CrowdStrike, how is it calculated? You start from the net income. Net income is negative. You add back DNA, you add back the share-based compensation, you add back the operating cash flow things, and you get your operating cash flow. Look at the net income, the operating cash flow, and the SBC. Okay. Net income, cash flow. Fair enough. In red, in this chart, you see the net income, mostly down. In blue, on this chart, you see the SBC, stock-based compensation. So stock options, bonuses to management, incentives to the sales team, etc. So stock options that dilute the shareholders like you and I. Okay? For the past, what's that? The past quarter, trailing 12 months. For the past quarter, the SBC, so stock options, were $300 million. Okay? Is it this one? Yeah. $287 million. Compare this with the operating cash flow of $300 million. What I want to say is the majority of the operating cash flows are due to SBC. The company is generating operating cash flows because the SBC is very large and you add it back. And I want to see if the company is growing, what is the revenue growth rate, what is the SBC growth rate. So I have this chart. Sorry if I'm not clear, I will just explain how everything is going. Okay, you have two lines that are here. In blue, this is the revenue growth rate that we have seen before. Let me just remove this first big line, and that will be it. Big line. Let me. Is it? Okay. In blue, this is the revenue growth rate. As we've seen before, it is decelerating. In red, this is the SBC growth rate. So the growth rate for bonuses, stock options, the management incentives, for example. What you see is this red line, most of the time, has been above the blue line. The payment to the management team has been growing at a faster pace compared to the revenue. Who is getting richer here? The shareholders or the management team? The shareholders or the employees? If I only look at this chart, the employees are getting rewarded at a faster pace than the revenue. To that extent, I see this as a yellow flag for my kind of investing. Maybe for you, yes, for many people, they love CrowdStrike. I understand the innovation, etc. But in terms of efficiency for the shareholders, I hate to say this. I have nothing against the company. I think the products, the services they have are great. But in terms of a shareholder's perspective, I don't like to see this. So for a couple of months, the red line was below the blue line. So the payments for employees slowed down and then everything accelerated again. So employees are being rewarded faster than shareholders. And I don't like this. I want to be the favorite kid in the family. So I want the shareholder to benefit. What about Fortinet? I said the philosophy was way different. Look at Fortinet. Same colors. In red, this is different colors. You switch the colors. In red, you have the revenue growth rate for Fortinet. Okay, this is for Fortinet. And in blue, you have the SBC, stock-based compensation. What did we learn? We learned that in the past, you had more SBC growth rate than the revenue. And then for a couple of years, since 2016, so almost a decade, things have changed. The company is focused more on innovation. And for the past decade, the revenue has grown at a faster pace than SBC. SBC is controlled under pressure. They don't want to favor employees, the management team, for example. They want to favor shareholders. So when you analyze a company, maybe it's true for cybersecurity companies, but every company, you analyze the numbers, quantitative analysis, quantitative metrics. It's also good, and I always do this, to analyze the qualitative things about the company. For example, on their slides for Fortinet, the second slide is about buybacks. Again, you have integration, acquisitions, buybacks. You have the tone of the management team, conservative, oriented towards the shareholders. They don't want to take more risk with the M&A. You don't see this in the numbers, guys. You have to do the work on the qualitative work. Third thing, who is favored here? The employees, the blue line, the SBC, or the shareholders with the revenue? For the past decade, Fortinet has very little incentives for their employees, I would say. You always favor shareholders. The SBC is very low. And if you want to know how the other companies are doing, I can show you for all the companies mentioned above. Compensation, comp, I have it. It should be it. SBC, no, I have it somewhere. It's on a ratio, maybe capital efficiency. Common size, stock base, so SBC, compared to revenue for everybody.
By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video.
What is the percentage of revenue that goes to SBC? How much is the SBC compared to the revenue? Okay. For Zscaler, the purple line, that's 20%. The SBC is 20% of the revenue. That's a lot because of incentives for the salespeople. Okay, fair enough. In green, that's CrowdStrike, 25%. So the SBC is really high. Again, incentives for salesmen, etc. But the formula is the same. I mean, you see the same thing that I do. It's 20-25%. In red, you see Palo Alto Networks, lower, but still 15% of the revenue. The SBC, stock options, free employees, free bonuses, are 15% of the revenue. Checkpoint is 7%. And who is low now? Who is the lowest of the bunch? This is the blue line. This is Fortinet. So if you only look at this chart, Fortinet is the most focused on shareholder returns. They pay little incentives. They have maybe fixed salaries. You don't have as many incentives towards your salespeople. It was not always the case. You see, 10 years ago, it was at 10. The SBC was 10% of the revenue, but it is trending down. So the company is lean, efficient, focused on buybacks, focused on shareholders. Again, I'm repeating myself, but you have a company in a growing industry with a huge tailwind in the cybersecurity industry, growing at minimum 12% per year. They expect to do minimum 13% per year. The growth rate in the past have been 20% per year. At net cash, doing buybacks, focused on shareholders, trading at a fair value right now. This is why I'm buying. All these aspects combined create the investment opportunity. Okay, so that was for this one. Let me check my notes and see if I have other things to say. Now, if you look at all the valuations for all these companies, you will see, can you see EV to free cash flow? Could be fine. You can see the EV to free cash flow for all these companies if you want to be invested in this industry. Well, first of all, it will be very hard to look at the valuation for all of them because not all of them produced free cash flow. Yeah, Palo Alto Networks is a different animal. Let me just remove this one. Fair enough. Well, this is the EV to free cash flow of all these companies. If you don't know what EV to free cash flow is, that's the enterprise value. So that's the market cap, but you take into account the debt or the cash, divided by the free cash flow. It will be a better tool to analyze all these companies. Okay? If you look at what we have seen, okay, let me just check my notes. Okay. Very well, okay. If you look at CrowdStrike and the EV to free cash flow, it was always high. Look at the green line. In the past, it was trading at the EV to free cash flow of 100, extremely high valuation. And now it is trading at the EV to free cash flow of 70. This is what I've been saying before. Maybe in the past, because of the large growth rate, the premium was deserved. But now, the growth rate is almost the same as everybody. It is growing 20% per year. Not 50% per year, not 60% per year, not 80% per year, but everything has converged. So, are you really comfortable buying CrowdStrike now with an expensive valuation of EV to free cash flow of 70? If the stock was growing, if the revenue was growing 50% per year, I would understand. But now, for the kind of investor I am, I don't see this as an attractive risk reward. Next one on the list, Zscaler. Same thing. EV to free cash flow of 50. In the past, it was 100. Same thing. In the past, Zscaler was growing 50% per year, their revenue. But now they only grow by 20-25% per year. Even less than this. So, is it warranted? This is a question I have for you. If there are investors of CrowdStrike, Zscaler, please use the comment section below to justify your buy. Maybe I'm missing something. My analysis is not perfect. I'm using this channel to just share my thoughts and share the journey and help you out if you are struggling to analyze businesses, to give you a framework in your analysis. But maybe I'm missing some parts of the story, but this is how I see the situation. What about Checkpoint? Well, Checkpoint, as I told you, they grow revenue by 5% per year. So it's normal that they deserve a discount. EV to free cash flow of 22. I see this as expensive actually. For a business that is not growing. We'll see. And now we have Fortinet growing at 15% per year with the EV to free cash flow of 29 right now. I bought at 27. So let's say it's 29, 30. Much more reasonable, I would say. Not excessively cheap at all. It's not a stupid, cheap investment, but much more reasonable compared to this. My question should be put as, is the premium warranted for these companies? And if I look at Palo Alto Networks, let me remove this, use the most recent data so we are not biased by this big drop. For Palo Alto Networks, we have an EV to free cash flow of 60. At the same time, they are growing 20% per year. Is it warranted? Is the premium warranted? Yes, Palo Alto Networks, they are the best. Best products, best services, best management team, best vision, exemplary model. But is it worth like double the valuation? I'm not sure. And this is why I prefer Fortinet. Out of the bunch, this is the company that is the most focused on its shareholders. And as a shareholder, I love it. I love it. Let me check my notes. Yeah, the only big thing that has changed recently is the convergence of the revenue growth. Let me put it back again. The revenue growth is the big change in the story for all these companies. Revenue 1 year growth. Look at this. This is quite meaningful actually. Quite meaningful. Palo Alto Networks is growing 15% per year. The revenue is growing 15% per year. Not that different than Fortinet. Is it really worth double the valuation? Same thing for the rest, growing only 20% per year. So yeah, I think you have plenty of updates on this video. I hope you like it. Don't forget to leave a like now, and I see you on another video. Bye bye.
If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, in this coaching program, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you have any questions, I'm here to help. Click the first link in the description below to get more information. You will get a short video that explains how everything works completely for free. No need for your mail address. Just click the first link in the description and I'll see you on the other side.